All right, class, let's get started. Before we dive in, just a quick note on the screen about the preparation of today's materials. Today, we're going to tackle a really key concept in Canadian tax, something that, can even trip up seasoned pros if they're not paying close attention. We're talking about specified corporate income. So, welcome everyone. Our goal today is to really demystify what we call SCI, or specified corporate income. I know, it sounds a little intimidating, right? But trust me, by the time we're done with this explainer, you're going to have a super solid, practical framework for spotting this and handling it when you see it in your future careers. Okay, so here's the game plan. We'll kick things off with the why, the incredibly valuable small business deduction. Then we'll get into the problem that the SBD created, which led to the SCI rule and its two key conditions. After that, we'll jump into some real-world case studies to see it in action, talk about the solution, and finally, we'll wrap up with the big takeaway for all of you. All right, let's dive right into part one, because before we can even begin to understand SCI, you have to appreciate the small business deduction, or SBD. Honestly, this whole thing is the reason the SCI rule even exists in the first place. So what's the big deal with the SBD? Well, just look at this. The difference is pretty staggering. Let's use British Columbia for our example. A small Canadian business, a CCPC, that qualifies for the SBD pays around 13% tax on its first $500,000 of income. But if you don't qualify, that rate shoots up to 26%. We're talking about literally paying double the tax. It's a huge, huge difference. And let's put that in dollar terms because that's what really matters to clients, right? That 13% difference on a $500,000 business limit works out to a potential tax savings of $65,000 every single year. For a small business, that's not just pocket change. That's a new employee, new equipment. It's major growth potential. So you can see why every eligible company wants to get its hands on this deduction. Okay, on to part two. So whenever you have something that valuable in the tax system, what happens? People get creative. And that creativity created a bit of a problem that the government had to step in and solve. Which leads you to this very logical, kind of sneaky question, right? If one SBD is so great, why not get more of them? Why not just set up a bunch of companies? Have your main company, then create a second one to provide it with management services, and a third to provide marketing, and have each one claim its own SBD and its own $65,000 tax break. See where this is going? This is exactly the kind of planning the SCI rules were designed to shut down. And this brings us to the government's answer, specified corporate income. The rule basically says that if your corporation is earning income by providing services or property to another private corporation, and there's a certain kind of non-arm's length relationship between you two, well, that income is generally not going to be eligible for the small business deduction. This is the rule that slams the door on that multiplication strategy. All right, part three. So we know the why behind the rule. Now let's get into the how. How does it actually work? How do you know if you're looking at SCI? It all boils down to two key conditions you have to check for. Think of it like a two-part test, like two gates you have to pass through. First, there's the relationship test. Is there a non-arm's length connection? If the answer is yes, then you move to the second gate, the income test. Is the income significant enough? You have to get a yes on both of these for the income to be flagged as SCI. So let's dig into that first test, the relationship test. It's met if the company getting the money, one of its shareholders, or, and this is the big one, anyone not dealing at arm's length with them has an interest in the company that's doing the paying. We're talking family members, like spouses, kids, parents. And the craziest part? There's no minimum ownership required. Even a tiny 1% share is enough to trigger this test. Okay, so let's say you pass through that first gate. The relationship test is met. Now we look at the income itself. The income will be SCI unless it's just incidental. And what does incidental mean? Well, the CRA's rule of thumb is 10%. So if the money you're getting from that related company makes up 10% or more of your total business income, it's not incidental, it's SCI. Okay, enough with the theory. Theory is one thing, but tax is all about seeing how these rules work in practice, right? So let's jump into part four and look at three classic case studies. This is where it all comes together. First up, let's talk about a lawyer, Mr. A. He's got his own personal law corporation, and it provides services to a bigger firm, ABC Law, Inc., where he also happens to be a 15% owner. So let's run our tests. Relationship test? Yep, for sure. A shareholder of his personal corp, that's him, has a direct interest in the payer, ABC Law. And assuming this is his main gig, the income is definitely more than 10%. So what's the verdict? It's SCI. He is not getting the SBD on that income unless the big firm agrees to assign some of its business limit over to his personal company. Okay, case number 2, the consultant. Mrs. B's consulting company has just one client. And guess who owns that client? Her husband. So, relationship test? Oh, absolutely. Spouses are always considered non-arm's length for tax purposes. And the income test? Well, if it's her only client, then 100% of her income comes from that one source. So that's an easy yes. This is a textbook example of SI. And for our third case, a contractor, Mr. C. His company does some work for another company owned by his brother. Again, relationship test? Yes. Brothers are non-arm's length. But here's the twist. Is it SCI? Well, it depends. This is where that 10% income test is absolutely critical. If the work he does for his brother's company is, say, 25% of his business for the year, then yeah, it's SCI. But what if it's just a small job, only 5% of his total income? Then it's incidental, and boom, the SCI rules don't apply to that income. Okay, part 5. We're getting pretty good at spotting the problem now. But what's the fix? What do you actually do when you realize a client has SCI? This is the most important part. So you've got a few ways to navigate this. First, the easy way out. Just make sure that non-arm's length income stays under that 10% threshold. Keep it incidental. Second, sometimes the companies might already be associated. That's a whole other topic. But it basically means they're already forced to share one SBD anyway, so the SCI rules don't matter. But the most common practical solution is the third one. The company that's paying the money can formally assign a piece of its own $500,000 business limit over to the company that's receiving it. That allows the smaller company to access that low tax rate after all. All right, let's bring it all home with part 6. If you remember only one thing from our time together today, I want it to be this next point. Here is the bottom line. As a future tax advisor, you can't just look at a business transaction on the surface anymore. You have to play detective. You have to dig deeper into the relationships behind the money. You need to be asking, who owns these companies? Are the owners related? Is there any cross-ownership, no matter how tiny? These questions aren't just details anymore. They are absolutely fundamental to figuring out if your client gets to claim that all-important small business deduction. So I'll leave you with this question to think about before our next class. You're meeting a new client. It's a classic family business, and they've got a few different corporations set up, which is very common. Based on everything we just learned, what is the very first question that should pop into your head to see if they're walking into an SCI trap? Give that some thought. We'll kick off our next session with that.